Welcome back to Policy Watch. India's bank non-performing asset problem is still getting worse, with gross NPAs rising almost 25% year-on-year in September 2015. On the other hand, rating agency Equirus says NPAs will come down to 5.5% from 5.9% it had projected earlier, because NPAs are getting restructured. Now, this could be good and bad news, particularly if the stress is being masked. High NPAs put pressure on the entire banking system and their ability to give fresh loans and help the economy grow further. So the question is, are NPAs coming down, or does a sluggish economy make matters more difficult? Here's a report.
Calling bad debts of banks a legacy issue, the finance minister is confident that banks can win their battle against willful defaulters. According to him, the imminent bankruptcy law will only empower them further. Gross NPAs of public sector banks rose to 6.03% in June 2015. They were 5.2% in March 2015. In August, the government announced 70,000 crore capital infusion in PSBs over 4 years, starting with 25,000 crore this fiscal.
Series of steps which the Reserve Bank has announced, which some of the banks have been implementing, will certainly improve on the quality of those assets. Additionally, the government also has been extremely proactive in responding to each of the sectors.
Jaitley also reviewed credit offtake by sectors like home, education and corporates, the Jan Dhan Yojana and Prime Minister's social security schemes.
The banking system, which is the lifeline of the economy, continues to fund various segments of the economy in order to grow. Now that the growth rates are somewhat picking up, and therefore the pressures of the past need to be removed as far as possible.
The government also has plans to sell shares in state-run companies when the market improves. It could raise about $14.4 billion by reducing stake in state-run banks to 52%. But so far, the government is struggling to meet its asset sale targets to plug its deficit. Kriti Mishra, Rajya Sabha TV.
Well, joining me to discuss this now is Saugata Bhattacharya, Chief Economist at Axis Bank, and Ajay Garg, Managing Director of Equirus Capital. Thank you both for joining me. So let me begin with you, Ajay. So what is the impact of this as we're seeing in the markets? And then let's try and understand what this means to the system as a whole.
So I guess, obviously because of the gross NPA levels and the NPA levels that have been going up for a period of time now, and one of the reasons, I guess we are seeing from the RBI also saying they can't reduce the interest rate, so the interest rate remains high. Definitely that has an impact on investment. We are not seeing any corporate investments happening, so corporate credit number is going down, which has a direct impact on the job growth market. I think these are the two significant impacts.
So you're actually saying the impact is pretty significant. It's not something to be ignored.
Yeah.
So Saugata, how bad is it today? I mean, so ICRA is saying that gross NPAs have risen. So is that a good sign in some ways, because we are seeing what could be the worst of the situation?
Well, I mean, good and bad both. For one, the technical reason for the increase in NPAs is because from the 1st of April, the RBI stopped its forbearance on adding fresh stressed assets into restructureds. So whatever banks were classifying as restructured assets is now showing up as NPAs. So that's the reason that you're seeing a technical rise in the level of NPAs. It's also good because the RBI and the Government of India have set in place a series of measures and processes by which both the existing stock, the stock of existing NPAs, stressed assets, can somehow be resolved. I mean, from restructures into resolution, and and going forward, the additional credit does not also lead to further NPAs. Things like the joint lending forums to identify stressed assets quickly, SMA accounting, stressed assets accounting, and so on.
So how does one distinguish between restructured and masked?
Restructured, essentially what used to be before, structured something. So I mean, this is essentially the story of solvency. So insolvent assets, insolvent companies versus companies that are stressed on liquidity. So otherwise the business foundations were good, but due to diminishing cash flows because of projects not getting stalled and so on. So I mean, the projects inherently were good, but it would take some restructuring in terms of elongating the interest payment process, putting in moratoriums on principal and so on, but the underlying quality of the asset was good.
Right.
So that's the restructured part, and bad projects were needed to be declared as NPAs.
Right. So on the other hand, we are still generating NPAs, right, at a rate of roughly 3.3%. Now, what does that mean, Ajay? I mean, it obviously means that there's something fundamentally wrong in the underlying corporate health of this country, isn't it?
So I think, if you sort of look at a couple of sectors which are in deep stress, and I think that will also be linked in terms of, how you see the sector indexes of infrastructure stocks or real estate or capital goods stocks have performed over the last 5 years. It basically tells you that, we are, facing two big, obviously there is an investment challenges that are happening. We are seeing an economic challenge in this thing, coupled with whatever slowdown in China impacting the metal stocks and having its own impact on in terms of how companies who have made investments in projects in anticipation of growth. So the capacities have been put in, but obviously there's not too much demand out there. And on top of it, on the infrastructure side, there's been obviously what we have always heard about a lot of delays in project approvals, and that has got added to the problem. So I think if you sort of look at this fundamental situation, and then there is a cascading effect which has in terms of all the other sectors thereafter.
Okay, so Shaugata, if we were to now look ahead, what's going to, everyone is working on this problem, but what really can resolve this? If companies are stressed, the economy isn't growing. One of the things Standard & Poor's said is that the economy needs to grow and demand needs to pick up, and therefore you would have potential solutions here. So assuming we don't have the funds to inject, the demand side is not looking strong, where do we land up then?
Well, so start with the assets first. Cleaning up corporate balance sheets, that's number one. The amount of leverage that companies had taken on. And in terms of everything that Ajay talked about, in terms of cash flows becoming worse, commodity prices coming down. So some amount of strategic restructuring has already started. Companies, other companies which are more...
we can see assets being sold.
Sold to those companies. So the extent of leverage is slowly coming down. So that's one. Secondly, banks' balance sheet, the exposure to these corporates, the assets, and the overall stock of NPAs. That's slowly getting cleaned out. One avenue are the new asset reconstruction companies that have come in. Many of these companies are better capitalized than they were before and can take on more of these stressed debts. You've just seen the RBI circular on allowing foreign portfolio investors to buy stressed bonds. In other words, them acting like vulture entrepreneurs, vulture capitalists to take on, so restructuring specialists can come in and buy out some of these bonds. So many of these initiatives are already in play. But together with that, the larger question of investments, remember there's a significant amount of capacity underutilization. So these capacities need to come in. To an extent, the 7th Pay Commission pay increases will come in, and that should aid some consumption to bring up capacities to par. But together with this, the government is also getting in more taxes and thereby having more resources to spend. So the government spending on roads and power transmission on some capital goods sectors is beginning to increase. The railways and defence are another areas that will potentially add to a significant amount, and that should get the production ball, output ball rolling.
Right. So let's come back to banks, right? So we were talking about this a little earlier. So one of the pitfalls of a high NPA situation is that banks actually start looking more at retail rather than lending to companies who in any case are finding it difficult to borrow.
Yeah, because I guess clearly there's not too many investments that are happening. So obviously there are not too many projects, not too much credit offtake from that perspective, because the corporates are, if you sort of look at it, their balance sheet debt has gone up over the last 5 years. So there's a pressure to sort of bring it down before they really get back into the investment mode and spending mode. And obviously there continues to be deposit growth, there continues to be need to deploy credit. So we are seeing that more and more banks and more financial institutions focusing on the retail side of lending, and that sort of, if you sort of look at someone like an HDFC bank, almost 55% of their book is retail, whereas in SBI 20%. So I think you'll increasingly see that for the banks too. Sorry. But
that's not good for the economy either, isn't it? Over time.
So if corporate credit doesn't happen, that means investment is not happening, so that has an impact on the job growth. So I think then the jobs will not be created as much as would.
So are we stuck in the middle of this vicious cycle, or are you seeing signs of us emerging from it?
So I think government is sort of taking some initiatives. It takes a time for that to play out in the market. We have seen that the government is also in recognizing the problem for some of the road projects which are being there. They are not really talking of only a BOT concept. It's your EPC contracts which are being awarded. That's sort of some movement happening there. In the DISCOM side, we are seeing the government trying to focus on how the recovery can happen.
State electricity boards and restructure loans.
So all those initiatives will help a little bit, but it's going to take time.
Okay, so that's one straight factor. Shaugata, what's your outlook?
No, so that's
both on the positive as well as the
completely
not so positive.
So typically, the state of a government EPC procurement cycle is anywhere between 15 to 20 months. So this government started in earnest around about September, October 14. and we are already 11, 12 months into that cycle. So my guess is that he'll probably take another 5-6 months for the traction for these contracts that are being awarded either through the dedicated freight corridors, the road contracts, the electricity contracts, and so on, beginning to actually translate into orders for capital goods and things on the ground. But having said this, I think there is still a set of systemic constraints. The global environment is one, particularly trade, exports. So the trade engine is not working very well, so that's misfiring. So a lot of the capacities that had been built for exports is now being shifted back into the domestic area, so that's adding to capacity. As Ajay was saying, because of imports, cheaper imports from other countries, that's also adding to the overall supply. So there are many constraints that need to be addressed, and but the government is beginning the process.
Right. So last question quickly. So one of the challenges is transmission of interest rates or lower interest rates. So do you see that to be a continuing problem?
It's not a problem, it's a process. So that process will happen. We've already seen 65-70 basis points drop in bank base rates out of the 125 the RBI has given. And as the system goes along, remember there's still a fair bit of liquidity tightness in the system. But as more and more deposits get repriced with lower cost funds, you will see banks, it's in the interest of banks, given to the extent that they possibly can, to begin to lower the lending rates.
Okay, do you agree, Ajay?
Actually, you're seeing the transmission keep coming down. For example, the last 50 basis point drop, which RBI did, there was hardly any transmission on that one. Compared to the previous ones, which were there. So, yes, unless until there is, because you see the NPA level going, and if you sort of add the number, a lot of the public sector banks are actually very close to their tier 1 capital, being completely under pressure from that perspective, which is also reflected in terms of how you see the PSU bank stocks prices working vis-a-vis of our private sector banks. So I think don't expect too much transmission on the interest rate to happen till we start seeing a revival on the NPA cycle.
Right. We've run out of time as well. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.